Good morning. I'm Larry Ripka, CEO of the Valmark Financial Group, and I'm just back from a trip out west. One of the outings on that trip involved going to an abandoned gold mine. While near that mine, I found this in one of the streams near the mine. It's known as pyrite, or better known as fool's gold. And there are stories of unscrupulous land speculators who used to sprinkle pyrite around claims, and unsuspecting newcomers were taken in by the sparkle and dreams of riches and would buy those claims. Thus, the saying, all that glitters is not gold. Today, I will decisively prove that Index Universal Life is the fool's gold of the life insurance industry, especially for policies that are premium financed. I would like to show you an actual in-force policy that was premium financed and sold 6 years ago. This client has already borrowed $3 million to pay premiums. And I'll demonstrate even in the most favorable of markets, this concept plain out just doesn't work. Since Index Universal Life came out 15 years ago, I've always been a skeptic. My primary concerns has been that policyholders are promised way more than they are likely to actually receive. 2 years ago, my article, Retirement Castles in the Clouds, was published by 3 professional journals. This article debunked the strategy of borrowing money from a bank to pay life insurance premiums on an IUL contract to produce retirement income. Today, I will share how this in-force IUL policy has worked, or better said, not worked, for a client in a death benefit-oriented sale. For the last 6 weeks, our design team has been working with Bill Boersma, the founder of the OC Consulting Group. Bill was retained a couple weeks ago by a client who had bought into one of these plans and was sold a very large IUL contract by an insurance agent and a premium finance company with a premium of $500,000 a year for 7 years. If the plan had worked like the client thought it would, it was expected to produce enough cash value to pay back the bank loan and provide an ongoing death benefit for his family. Now 6 years in, even with record high equity returns, the client is confused about what he purchased and doesn't understand why it is not working as well as projected. He contacted Bill to analyze the program. 6 years into the policy, there doesn't appear to be anything terribly wrong, at least on the surface. So far, the bank has not demanded additional collateral for the loan. The client was puzzled with the market up so much. Why was the policy behind the original 6.25% projections? During this same time, the client paid the premiums into this policy, an uncapped deposit into the S&P 500 stocks with dividends reinvested during this time would have produced 126% returns. That's an average of 14%. Now, the IUL policy statement said the policy had averaged 6.88%. But still, the cash value is slightly lower than the 6.25% that was projected. Now, the difference between the cash value and the projected cash value is slight. The bigger issue is the changes that have been made by the insurance company during the time the policy is owned that disadvantage the client going forward and assure that it now has a 0% chance of giving the client what was originally promised. Looking at this fact pattern, it's hard to imagine one more favorable for IUL than 2015 to 2021. The market has been up 5 of the last 6 years. The loan rate on the money borrowed from the bank has dropped from 3 to 2.2%. So how is the policy now approaching its 7th year doing so much worse than the original 6.25% projection. The in-force illustration shows that if the money needed to repay the bank loan is scheduled to be withdrawn as originally projected, the policy will immediately lapse. There will be no free insurance, but actually a significant loss. And the situation only gets worse as cap rates continue to plummet. So let's dissect the difference between what the client was promised and what they actually got. First, IUL does not actually invest in equities or stocks of any kind. IUL contracts are not securities. It's actually the cash value is part of a general account product that the insurance invests in low yield bonds. The carrier uses a small portion of that cash value to buy derivatives that, quote, provide the upside. If the carrier is earning, let's say, 4% on its general account, it could illustrate a 6% crediting rate on the IUL contract, assuming that the derivatives invested gained 50%. This is essentially what the complicated insurance regulation known as Actuarial Guideline 49 or AG 49 allows companies to assume. It's a huge assumption to make on this product. Second, since the upside is referenced to an index that the derivatives are invested in, and it's not directly invested into the securities of the S&P 500, there are no dividends with index products. Over the 6 years in question, the uncapped return on the S&P 500 without dividends was 102%, 24% less than if dividends had been earned and reinvested in stocks. Historically, dividends are an even more significant element of what we consider returns on equities, and IUL products do not include these dividends. Third, and perhaps the most important element, IUL contracts have a key contractual provision called caps or participation rates that limits the client's upside in the tracked index. The original IUL assumption had a 12% cap at time of issue. In the last 6 years, it has now dropped to 8%. So IUL projections assume the cap remains constant. So that original IUL illustration assumed a 12% cap going forward. In the case of the disappointed policyholder, the cap has come down considerably since the policy was issued, resulting in less and less upside. Most IUL contracts only guarantee that the company will credit 3%, and as bond yields fall, there's less money to invest in options and the caps continue to come down. See the attached chart here where we show another IUL policy with a 10-year history of the caps. They've fallen from 16 to 9%. But remember that original illustration projected that 16% forever. All general account life insurance products have been impacted by falling bond rates. But IUL contracts have been more impacted and the rates have fallen faster than any other kind of insurance, be it UL or whole life dividends during the same period. The gold plating continues to flake off these IUL policies, and clients are discovering that they have lead instead that pulls policy performance down. Finally, state-based insurance regulation allows life insurance salespeople to show clients IUL policies based on these absurd assumptions in AG 49, 45% profits on the derivatives. IUL doesn't offer financial arbitrage when premium finance, but regulatory arbitrage. More than 10 years ago, the SEC moved to regulate this product as a security, and in fact had final rules in place to do so. The life insurance industry, with some clever lobbying, got this product taken out of SEC jurisdiction and left it with the state insurance regulators. So today, IUL is an outlier from a regulatory perspective, with no best interest standard and very, very limited consumer protections. This is why I, along with 11 other industry notable colleagues, urge the National Association of Insurance Commissioners to materially change AG 49. Ultimately, no insurance company can offer a product that produces greater returns than the underlying financial instruments that back it. A thin slice of derivatives on 95 or 96% bonds cannot produce these kinds of returns. If it did, every investment manager in the world would be featuring this strategy. IUL may be a riskless product, not for consumers, but for the insurance companies that sell it and the banks that lend money on it. IUL policies are actually complex and opaque financial instruments. And it took us the better part of a month for us to help Bill untangle this mess and figure exactly how much it will cost the client to get himself out of this transaction. Valmark member firms have been aware of the risks of IUL since this product first came out. We weren't fooled. After review of this transaction, I suspect almost every client who's entered into one of these transactions in the last 5 or 6 years has been equally negatively impacted. And Valmark firms are well equipped to help the clients sort out gold from fool's gold. In a series of white papers, articles, and even a book, we've outlined how we can help insurance professionals build insurance plans that last and are in the client's best interest. If you would like a copy of our 10X Life Insurance 10X book or any of our white papers or articles that I've outlined below, just contact Brandy at the email address on the screen. We're proud to work with and for ethical and informed member firms who create well-designed insurance plans that create certainty for clients and their families. Real insurance can be golden protection when properly designed and managed. For us, bringing the golden rule to life means offering products that we would buy for ourselves if our own financial future depended on it. At Valmark Financial, we are proud to help our member firms bring the golden rule to life.